you take M1 and take 40% of that and say, okay, that's how much gold I need to back it up. Okay, how much gold do I have? The answer is 8,133 tons. That's how much gold the U.S. has. And just do the math. This is 7th grade math. What would the price per ounce have to be for 8,000 tons to back up M1? And the answer is $27,000. By the way, I did the same math not that long ago, well, 7 or 8 years ago, and the answer was closer to $15,000. But the reason it's higher, gold is still gold, but the money supply is a lot bigger. So with the same amount of gold and a larger money supply, you need a higher price per ounce to back up the money supply.
After years of trading in a range below $2,000 per ounce, gold has seen its best performance since 2019, as the yellow metal surged to a new all-time high near $2,450 in early May, and looks poised to continue its trek higher, according to one academic. Deeply rooted in financial history, the correlation between gold price and money supply growth has remained steadfast for decades. As affirmed by the World Gold Council, this enduring relationship spans over 50 years, with gold consistently mirroring global money supply growth, often surpassing the performance of T-bills. Jim Rickards is a prominent investment banker and author, renowned for his finance and precious metals expertise. In his recent analysis, Jim Rickards observes that by aligning the current U.S. money supply with the U.S. gold reserves, the price of gold would need to rise to about $27,000 per ounce. U.S. money supply increased by 40% during the pandemic in the following year, as politicians and the Federal Reserve created money to avoid an economic depression. This excess liquidity has boosted the price of goods, housing, labor, etc. Gold was slower to attract this liquidity, but it was inevitable that excess cash would eventually find its way into gold, especially as we also started to see wage inflation. While in the event of eroded confidence in U.S. government securities and the dollar, Rickards emphasizes that a rush to other major currencies will only occur if they are all interconnected. Instead, he suggests that a reluctant but necessary return to a gold-backed system might be required to restore confidence. In fact, since the creation of the Federal Reserve in 1912, the U.S. dollar has lost nearly 98% of its purchasing power. The gold price, on the other hand, has multiplied 100-fold. This may seem like a lot, but gold has just maintained its purchasing power. Today, 1 ounce of gold purchases approximately the same goods and services it did 100 years ago. Now, we present the clips of Jim Rickards' insights from his recent interview with ITM Trading Incorporated. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Well, it's a predicate, so it's a little bit different than a hard and fast prediction. The number was about $27,000, you're right. There's a predicate, which is what happens if investors, savers, markets around the world lose confidence in the U.S. dollar. And by the way, if people lose confidence in the U.S. dollar, don't think for a minute that they're going to run to the euro, the yen, pound sterling, Canadian dollars, or whatever. They're not. All those currencies are part of a global euro dollar, U.S. dollar system. So if you lose confidence in U.S. government securities, for example, the U.S. dollar, you're not going to run to German bonds or Japanese government bonds. That whole system is going to be severely impaired. In which case, you may have to go back to some kind of gold standard, gold-linked, gold-backed in some fashion, not because you want to. There's no central bank in the world that wants to go to gold, but they may have to restore confidence. Now, if you do, if you say, okay, we have to get back to some kind of gold system to restore confidence, what would the price of gold have to be to make that system work? Well, we have a lot of historical precedent. There was a real gold standard solid gold standard from 1878 to 1914, modified gold standard from after World War I, say 1919 through World War II, the Bretton Woods standard from 1944 to 1971. So we do have precedent for this. In every case, you don't have to have enough gold to back 100% of the money supply. Some of the hard shell gold bugs say you do, but that's not true. Historically, you need between 20 and 40%. So let's just take 40%. Look at the U.S. money supply, and I use M1 because it's borrowed Fed-based money. It includes checking accounts. It's kind of like the money from the banks that drives the real economy. So if you take M1 and take 40% of that and say, okay, that's how much gold I need to back it up. and then say, okay, how much gold do I have? The answer is 8,133 tons. That's how much gold the U.S. has. And just do the math. And this is, as I said, this is seventh grade math. You say, what would the price per ounce have to be for 8,000 tons to back up and one? And the answer is $27,000. By the way, I did the same math not that long ago, well, 7 or 8 years ago, and the answer was closer to $15,000. But the reason it's higher, gold is still gold, but the money supply is a lot bigger. So with the same amount of gold and a larger money supply, you need a higher price per ounce to back up the money supply. And by the way, I spoke to Paul Volcker about this, and he agreed. He said he wasn't advocating for a gold standard, but he said if you had to go back to a gold standard, he just threw his hand in the air and said, the price of gold would be unbelievable. And of course, he's right. So if things kind of remain the way they are and the confidence in the dollar remains, we can talk about that, by the way, because there are arrows directed right at the heart of confidence in the dollar having to do with Russian assets in the war in Ukraine. But if confidence is maintained, then it's a market factor. Maybe you don't get there. But if you have to go back to a gold standard, $27,000 would have to be the price in order to avoid massive deflation.
Regarding the BRICS alliance, Jim Rickards highlights its potential to reshape the global monetary system. He suggests that while individual currencies within the BRICS may not attain reserve status, collective efforts could create a new currency for intra-BRICS trade. The BRICS countries are driving a surge in precious metals, notably gold, as they aim to back their future currency as an alternative to the US dollar. The Global Precious Metals Index MMI has been steadily increasing by 8.25% each month, with April seeing an even more pronounced jump in the metal's value. Several factors contribute to this gold rush, including inflation hedging, expectations of interest rate cuts, and geopolitical uncertainty. Interest in gold from BRICS countries, particularly Russia and China, has been driving the rally, with efforts to encourage other member countries to participate. Let's get back to the interview.
The BRICS, as they are today, so that includes 4 new members who joined the summit in South Africa last year, so we're now up to the BRICS 9, I guess, BRICS Plus, call it. They represent over 50% of the world population. If you use purchasing power parity, about 55% of global GDP. 2 of the 3 largest nuclear arsenals. 3 of the 5 largest oil producers. This is not your grandfather's third world. These are not poor, impoverished third world countries. These are political superpowers, military superpowers, and economic superpowers. So first of all, it's not trivia group, number one. Number two, if you're asking, will the Russian ruble be a global reserve currency? No. Will the Chinese yuan be a global reserve currency? No. I could give you 100 reasons why, but they don't have bond markets, they don't have good rule of law, they don't have repo primary dealers, et cetera. They don't have all the things you need to, in terms of having a securities market, to be a global reserve currency. So you can forget about that. But could they collectively issue a new currency? Call it whatever you want. They call it a bank order. That they would all accept and trade between each other, and that actually third parties would be welcome to join with an issuing bank and a clearing mechanism and a valuation mechanism. Yes, that would not be that difficult.